I've been here at age about just about 3 months and enjoyed having set my own investment management business up, designed exclusively for professional advisors. Prior to that, I was head of strategy and research for a European investment bank. And prior to that, I was a CIO, Chief Investment Officer, for a UK private bank, Brown Shipley. But I'm here ostensibly to give you a bit of a chat around markets and economics. And I've no right to do that really, because I've never sat in an economics class in my entire life. My background is in maths and theoretical physics. I used to be a maths teacher once upon a time. But having spent 17, 18 years in this industry, I've come to the realization that if you're going to talk about economics, it's really impossible to do that unless you also bring in the context of politics and also history. You probably need a little bit of sociology and anthropology along the way there. But history is probably where I'd like to start today. So there we go. If I can just bring up that first slide. Now, history, as we all know, is littered with memorable dates. 1066 is probably the one that we've had drummed into us from our time in school. But you take, 1805, the Battle of Waterloo, 1914, World War I, 1939, World War II. What you tend to find is a lot of these memorable dates in history seem to have some sort of conflict connotations about them. They're littered with memorable dates, which really recollect wars and times of conflict amongst human beings. And so I want to kind of keep that theme going and introduce you to the latest war that we have on our shores, which isn't the conflict in Iraq. It's not the conflict that we've seen in Afghanistan. The latest conflict we got in the UK was actually launched by Mervyn King on the 5th of March 2009, where the Bank of England, the members of the MPC, essentially declared war on savers. They took interest rates down to 0.5%, and they began this experiment called quantitative easing, which is essentially the printing of money. And during which time, they've held interest rates at 0.5% or lower for almost 10 years. And they've gone on to print £445 billion of new funds by this process of quantitative easing. And the casualties have been quite immense, really. There's £2 trillion of customer deposits held in the UK banking system. There's over 20 million people in the UK with money on deposit in the UK banking system. And every single one of these people is being impacted on a day-to-day basis by a continuous volley from the Bank of England, now replaced in its leadership with Mark Carney. But General Mark Carney has maintained this war on savers, and the casualties are really quite immense. If you don't believe me that it's a war, I'd really like you to take a look at this slide, which shows you UK debt as a proportion of GDP since the turn of the last century. And what you see on this slide is very clearly, you can see the impact of debt to GDP during the First World War campaign. In order to finance that campaign, we had to take on significant levels of debt as a nation. And then, of course, post-World War I, you start to see a reduction in those debt levels. Until then, you get to 1939, and you get to see the impact of World War II, which then took us to a record high in the UK of debt to GDP, almost 250%. Now, we had a long period, career aside, we had a long period of essentially no conflict in the Western world. Other than the Cold War, and we were progressively able to lower that debt to GDP ratio until you come all the way through to 2009. And in 2009, you see that sharp spike where debt to GDP goes from less than 40% to now over 80% debt to GDP ratio. And that is essentially to fund the war on savers. Now, this is important because this isn't a UK only phenomenon. You'd see a similar spike in the US, you'd see a similar spike in most of the major European nations, and you'd see a continuous spike in Japan. And now that we've got a debt to GDP ratio in excess of 80%, we can confidently make some predictions now. And the prediction is a quite stark one. The UK government will default on its debt. the US government, the Japanese government, and a lot of European governments will also default on their debt because their debt to GDP ratio stands at over 80%. A lot of people think that sovereign defaults are essentially a rare phenomenon, but sovereign defaults, the defaults by government issuers, are really quite common, and we've had a number in the past just 10 or 20 years. We don't have to go too far back to 1999 to see the Russian debt default. We go similarly to 2001, you see the Argentinian debt default. The Greeks defaulted on their debt twice in the past 10 years, both in 2010 and again in 2012. The Cypriots defaulted not just on their debt, but on their bank deposits. They took 30% out of every single Cypriot bank account in 2013. And as we sit here today, the Venezuelans are currently defaulting on their debt. So the notion that sovereign defaults are rare occurrences just really isn't the case. But I go back to that statement that the UK, the US, the Canadians, a lot of European nations, and the Japanese will all default on their debt because they have a debt to GDP ratio now in excess of 80%. Now, if you think, look at the figures in 1950, post-World War II, and you see the massive reduction in debt to GDP, you might well question, okay, well, I don't remember the UK defaulting on its debt, so how did we go from 230% of debt to GDP to less than 30% debt to GDP around the turn of the century? Well, I'd counter that and say, well, we did default on our debt. It's just the nature by which we defaulted on our debt was quite different from what we saw in Greece and what we're seeing in Venezuela at the moment. And the nature by which we defaulted on our debt was inflation. Anyone who lived through the 1970s will recall double-digit levels of inflation, in fact, over 20% levels of inflation. And as a consequence of that, it just erodes your purchasing power. And that really is what a default is. When the Greeks, when the Cypriots took money away from creditors, the net impact was that those creditors just didn't have the ability to make purchases into the future. And this isn't a new phenomenon. I could take you back to the 17th century, where this was quite a common occurrence. And you're looking at a picture now of a current £2 coin with that inscription around the edge, standing on the shoulders of giants, which was put there by Sir Isaac Newton. Sir Isaac Newton, one of the greatest human beings ever to walk the planet, but certainly the greatest physicist of all time. And he received his knighthood not for being a great physicist. He received his knighthood for solving the problem of the day in the 17th century, which was, as you engaged in economic transactions with your actual gold and silver pieces of coin, unscrupulous traders would take your gold and silver coin and they would shave a little off the edge. They would collect all of those shavings, they would smelt them down, and they would create money out of thin air. They would create new money out of those tiny bits of shaving off the edge of the coin. And Sir Isaac Newton solved this problem by, if you look really closely on that £2 coin, you see those tiny little lines milled into the edge of the coin. They were put there by Sir Isaac Newton in order to solve the problem of the day, which was the clipping of the coin. Now, in the 17th century, if you were caught clipping the coin, you were hung, drawn, and quartered. Roll forward almost 400 years, and now the metaphorical clipping of the coin, the creation of money out of thin air, that's now state-sponsored. It's essentially what quantitative easing is. Now, back in the 17th century, the consequences of clipping the coin were it created high inflation, and it led to a devaluation of the currency. And that's exactly what you will see and have seen over the past 9 years since we started doing quantitative easing. If you left your money in a UK bank account from March 2009, the value of your savings has increased. The value of your savings has gone up by 4%. But over the same period since March 2009 to the present day, in that 9-year period, the value of inflation has gone up by almost 30%. So you've lost a quarter of your purchasing power if you left your money in a UK bank account for the past 9 years. And for me, that's a default by any other name. That quantitative easing has also led to some real market shocks and some real market problems. And no more are those problems evident than the bond market. At this moment in time, as we sit here today, and the number fluctuates on a day-to-day basis, but as we sit here today, there are currently $9 trillion of government bonds out in the marketplace trading on negative yields. Now, that's just worth pausing for a moment and thinking what that actually represents. $9 trillion of capital in the capital markets currently receiving a negative yield. So that's, just to think about what that means, you buy a German government bond and you pay, let's say, 103 euros for that government bond. And over the next 10 years, the German government will give you some coupon payments back, and they will give you 100 euros back in 10 years' time. The sum of all of those coupon payments and the sum of the principal payments at the end still comes to less than 103 euros. So you're lending money to the German government today for the next 10 years, and you'll receive less money back over the course of the next 10 years than you give the German government today. It's the equivalent of renting space in the Bundesbank vault. And it just bears no relevance and no semblance to what we actually see in the marketplace. What that is telling you is that bond markets and bond investors are seemingly so worried about the future 10, 20, 30 years that they are willing to rent space in the Bundesbank vault. And it's hard to tally that bit of information with what we see in the outside world. We see economies growing at pretty healthy rates at this moment in time. We see equity markets trading on nice valuations, and we see property markets which are really quite strong at this moment in time. So it's hard to correlate the views of bond investors and the views of property investors and the views of equity investors at this moment in time. And in our view, it's because the bond markets are being manipulated. You've had $13 trillion of quantitative easing collectively by central banks over the past 9 years, and they have basically forced that money into a bond market that doesn't want that money and doesn't need that money. And that unconventional policy has led to a situation where we really now have to challenge some of the conventions that we hold dear as investors. And I think the best place to start with that is, let's stick with that bond market. What you're seeing on the chart here is the evolution of bond market duration. And what that means is, if interest rates go up by 1%, how much will your average bond fall in price? We all know that when interest rates go up, bond prices go down. Now, when I started managing fixed income money back in 1999, I recall very, very readily, you could buy a UK government 10-year bond on a yield of 5%. And if yields went up by 1%, you would lose 6% of your capital. Let's roll that forward to the present day, where the yield on a 10-year government bond is around 1.5%. But if yields rise by 1%, the value of that bond falls by 12%. And so we've got a situation where we've doubled the level of risk that you have to face as an investor when you buy a portfolio of government bonds. And yet at the same time, the level of return that you get on that investment has fallen by over 2/3. Now, the scary thing about this is we as an industry almost force our cautious and conservative investors into portfolios of government bonds and corporate bonds. So we've increased their risk profile, we've lowered their return expectations, and we continue to do this as an industry. So we really need to rethink what we mean when we talk about risk. The idea that we are forcing our most cautious and most conservative investors into this type of investment just makes no sense to us whatsoever at AJBL. We need to rethink what we mean about asset classes. We'll all have been schooled in the theory of modern portfolio theory. Now, it's hard to believe that we still use the adjective modern for a theory and for a doctrine that was written in the 1950s. Harry Markowitz wrote the modern portfolio theory in the late 1950s, and here we are 60 years on, still using this theory and still calling it modern portfolio theory. Now, the concept behind modern portfolio theory is you end up with more efficient, better portfolios when it comes to risk and return by building diversification into your portfolio. And that's why I put on this slide the correlation between UK and European large caps over the past 20 years or so. If we take this back to 1990, you can see that the correlation between UK and European large caps back then was less than 50%. The correlation you can see is about 0.45. And again, roll that forward, in the height of the European debt crisis 2011, the correlation between UK and European equities was almost 100%. And these days, it's around 80 to 85% correlation between UK and European large cap equities. And so the idea that we are building efficient portfolios by spreading our money around the globe and diversifying between UK, US, and European equities, given that the correlations are now so high, we've really got to question whether we are genuinely building the most efficient portfolios. I've not got the data on the slide here, but what I can tell you is actually the correlation between UK large cap and UK small cap companies is actually around 70%. And so as the world has become much more global over the past 60 years or so, and as economic cycles have become a lot more correlated and market cycles are much more synchronized, what we actually see when we think about putting portfolios together is you need to rethink what you mean when we talk about asset classes. And so at AJ Bell, we don't make a great deal of distinction between UK and European equities. We make a distinction when it comes to currencies, but we don't make a distinction when it comes to equity valuation, because let's face it, both in the UK and European large cap arena, they are large global multinational organizations, and they will all be impacted by the same factors. Contrast that if you bring technology into your portfolio, if you bring small caps into your portfolio, you bring diversification into your portfolio, and you can build more efficient portfolios as a consequence. But the single biggest thing we need to reconsider as investors these days is what we mean when we talk about costs. Again, you know, I've been in this industry for around 20 years now. I recall putting illustrations together for investors way back when, where you would project forward, assuming that you would make a 12% return. And eventually, we took that return expectation down to around 9%. I remember it going to 7%, and these days it's probably more likely around the 5% mark. Now, as a consequence of that, the cost that investors face have to fall to similar sorts of magnitude. At this moment in time, there are 15 million investors in the UK, and the average balance that an investor holds in the UK is just £48,000. Those investors are buying into, on the whole anyway, still in the UK, 75% of that money is invested in active funds. Just a quarter of the retail market is currently invested in passive funds. And then those investors are paying around 90 basis points in order to gain access to market portfolios. You'll have seen only this week that there were a number of managers in the industry, I think 64 in total, who've been fined by the FCA and asked to redress their customers because they were purporting to offer active management, but they were basically just closet tracking. And so what we think is important is investors need to be paying only for the asset management services that they receive. We think it's possible to offer intelligent investment at a passive price. And that passive price for us is just 15 basis points. And the consequences for investors are huge. Let's take that average investor today with a balance of £48,000 and invest them in a portfolio that generates a total return of 5% over the next 20 years or so. 20 years on, just by removing the cost from 90 basis points to 15 basis points, we end up in a situation where that investor is now £16,500 better off. And our goal at AJ Bell is to bring intelligent investment at a passive price to ensure that it's customers who end up with the wealth at the end of the day, and not the asset management industry that ends up the wealth in their pockets. And so when I came to AJ Bell just 3-4 months ago, the range that we had in place was, you know, a nice range, but pretty basic, if I'm frank. So we had 5 risk-weighted portfolios, from cautious all the way through to adventurous, and they were available on platform as a passive MPS service, and available as wrapped up funds on a passive basis as well. Those portfolios were risk mapped onto the dynamic planner range, ranging from 3 to 8. And so the first thing that we've done is we've decided, given our understanding of what advisors are looking for, it's not just about suitability at the point of sale. What is equally important going forward is your ongoing suitability on an annualized basis. And so one of the first decisions we've made is we've decided to partner more closely with Dynamic Planner, and rather than just running our portfolios and then mapping our portfolios to the Dynamic Planner range, we now manage our portfolios with reference to those ranges in the first place. We now offer risk-first, outcome-orientated portfolios. And that's why we've been able to make that migration from the Magenta badge service to the Gold badge service. We'll continue to map our portfolios to the Finametrica platform. And very shortly, we'd expect to announce a partnership with the eValue, where we'll also risk map our portfolios. So there's some of the things that we've done in terms of suitability and attitude to risk on the range so far. We've also extended the range of the portfolios. We've added a higher risk portfolio, a Dynamic Planner 8 global growth option. And on top of that, we've also introduced some income options as well. So we've 2 income portfolios available to investors. The Income 1 portfolio is a lower risk portfolio, which aims to give a target yield of 4% and looks to preserve capital over the longer term. And the Income 2 portfolio, which is a higher risk portfolio, is again offering a yield of around 4%, but will look to preserve investors' capital, not just in absolute terms, but in real terms going forward as well. And interestingly, in the Income 2 portfolio, there's not a single bond to be found. That's a income portfolio with no bonds in it whatsoever. But if you look at this range, it still looks as if we are wedded to the idea of passive investment is the only way to go. And that's absolutely not the case. Since joining the business, I'm keen that we get out into the market with a number of commitments. One of our first commitments is that of choice. So you can see that we've extended the range of portfolios available to investors, but we don't want to be evangelical on the debate between active and passive portfolios. So in tandem with extending the range, we've also extended the implementation routes as well. So just a couple of weeks ago, we launched our active MPS range. Again, you will see the same strategic and tactical asset allocation views in the portfolios, but instead of being implemented via passive investment vehicles, we will implement those portfolios using active investment managers, the names that you probably all know and love out there as well. Our second commitment is around costs. We believe that it's possible to offer intelligent investment at a passive price. And so the fee that you pay to AJ Bell on every single one of these products is just 15 basis points. And that makes us the lowest cost MPS service in the marketplace. Of course, there's a little bit of VAT on our 15 basis points for MPS. But again, similarly in the passive funds, the fee to AJ Bell is just 15 basis points. There's obviously some synthetic costs of buying the underlying portfolios. For the passive range, that ranges between around 12 to 16 basis points. And on the active portfolios, that ranges between 50 to 70 basis points. So in total, it is possible to deliver an entire portfolio on platform in passive format for around 50 basis points, and an entire portfolio, including your platform fee, in active implementation routes for around, well, in some cases, actually less than 100 basis points. And the final commitment is on communication. At AJ Bell, we never forget whose money it is. And so what we've also committed to do is to be completely transparent with all of our portfolios, to the point of we will tell you not just what is in the portfolio, but we'll tell you when we trade on the portfolio. And on top of that, we'll tell you why we traded on that portfolio. We'll tell you all of our active tactical asset allocation views. And perhaps if I can just spend a short while telling what they are at this moment in time, the single biggest view we have on tactical asset allocation is, perhaps I've alluded to this earlier on, we believe that government and bonds are possibly one of the stupidest investments you can make at this moment in time. And as a consequence of that, even with our cautious, moderately cautious portfolios, we've removed our exposure to standard government bonds, and we've moved all of our government bond exposure into effectively cash and very short-dated bond instruments. We believe the bond market is possibly the greatest misallocation of capital that we've ever seen in the history of mankind, and we don't wish to participate in that. And so we've shortened the duration on our bond portfolios. We've removed all of our standard government bond exposure within portfolios and replaced that with cash or really short-dated bond instruments. We believe there will come a time when inflation rises, and only at that time will the bond market start to make sense again as an investment asset class. And so that view is implemented within our portfolios. And if you were to log onto our site in the next week or so, we'll release a compendium of what our views are on asset allocation. You'll see exactly what's going on in your client portfolios and exactly what we're doing with your clients' money and why we're doing it. So those three market commitments on choice, cost, and communication are really what we want to offer the marketplace. So that reduction in cost, that improvement in choice, and that commitment to communication can really be boiled down to a very simple maxim, really. I go back to that average £48,000 investor that I referred to earlier, and sure, over the next 20 years, that could lead to £16,500 better off for that investor by reducing their cost from 90 basis points to just 15 basis points. But if you want to bring that shorter term, £48,000 invested at a cost of 15 basis points versus 90 basis points is an annual saving of around £360. Or if you want to think of it in an alternative way, £1 a day. So moving your clients' money from the active portfolios, which you see invested with average cost of around 90 basis points, to our intelligent investment at a passive price of just 15 basis points, can save your clients on average £1 a day. That's about enough from me. Let's see if we got any questions on the board. There's some questions about about the quality of the audio signal, so apologies if that wasn't great earlier on. Super. Okay, we're not inundated in questions, so as we said, this is a half-hour call. We hit that bang on the button. I'll let you chaps and ladies get back to your desks and look after those clients. Thanks very much.